Global markets had a turbulent week, with stocks falling Friday in Europe and a mixed picture in Asia, where emerging markets, such as India and Indonesia, are particularly prone to the effects of Turkey's teetering economy. The United States has threatened additional new sanctions on Turkey if detained American pastor Andrew Brunson is not released. Still, State Department spokesperson Heather Nauert has made clear the United States is not to blame for Turkey's economic woes.
Turkey's financial situation has been in the works for quite some time, and it dates prior to the imposition of sanctions on August, I believe it was August the 1st.
Analysts agree Turkey's economic problems run much deeper and predate the current feud between Turkish President Recep Tayyip Erdogan and U.S. President Donald Trump.
Turkey's economy is structurally unsound in the sense that it is very heavily based on rapid growth, cheap credit, reliant on projects in the construction sector. And the most dangerous part is that it is very heavily leveraged in terms of foreign debt, especially dollars. And so with the depreciation that we're seeing in the lira versus the dollar of 40% already this year, it makes it much more complicated and expensive for Turkey to be able to repay those debts.
Investors are carefully watching the links between Turkey and Asian Pacific countries, which are among Turkey's top 20 sources of imports, led by China.
I would say we're not heading for a 1990s crisis because we don't have the risk of contagion from Turkey, which we had within the Asian tigers in the 1990s. That said, I do think that tighter global credit and liquidity conditions will be damaging for emerging markets writ large.
Still, most analysts remain deeply concerned about Turkey's economy, particularly whether or not Turkish firms will be able to service their debt. Saine, VOA News, Washington.